Hello, dear friends. My name is Marianna Schwartsman. I'm a trust and estates attorney in New York. Today we're starting with the first video in the series talking specifically about estate planning and asset protection planning. And as you know, I always advocate for planning. And many of you are in a category where you believe that if you have modest amounts of net worth, maybe this topic does not pertain to you. And I guess this video is going to be specifically targeted at you. I'm going to try to answer the basic question as to when should I consider doing asset protection planning? And, just in a summary way, okay, I'd like to speak about several important aspects, right, of when you should at least think about it, okay, and at least consider this subject as it relates to you and may help you. And then later on in the studio, we're going to have a guest who's going to speak to us about also a very important vehicle that relates to asset protection planning and also planning in general. Very important too. So those with modest net worth, yes, you need to consider asset protection planning. It's important. Those with significant amounts of assets, obviously this goes without saying that this subject pertains to you, but anybody with significant recurring amount of credit card debt or any debt in general, it is very important for you to consider asset protection planning. If you have that debt, maybe as the result of the business that you're in or the trade that you're in, it really, you have to focus on the subject. Homeowners, please think about it, especially if you have significant amounts of equity in your investment real estate or your primary residence. Consider planning for protecting those assets. And my favorite category, obviously, those of you who are in professions that carry high probability of liability, those doctors out there, those dentists out there, medical professionals in general, you're constantly under attack for liability purposes. And those of you who are in trucking business, let's say, or you run daycare centers, consider this to be a very important subject for you, for your family, for your planning purposes. So I'd like to invite somebody to join us. And a guest with us today in the studio is Mr. Vlad Shafir, is a financial advisor, and he is with a company called Forest Hills Financial Group, and you have his phone number for contact purposes running on the bottom of the screen. And Vlad is going to answer a very important question that I hear from my clients who come and consider different aspects and different mechanisms for their planning for their family. And that question is, the difference between whole life and term policies. But first of all, let me welcome Vlad. Welcome. And we're glad to have you back. And like you to tell us a little bit about what it is that you do and talk about the policies and the difference, because this is the first question people come into my office and they ask me, Marianna, talk to us about the difference between whole life and term. Okay, thank you.
Hello, Marianna, and greetings to all your viewers. So as you mentioned, I'm with Forest Hills Financial Group. At Forest Hills Financial Group, we do comprehensive financial planning for individuals, for business owners, for people who are starting their lives and people who are about to retire. And so life insurance is a topic that comes up very often because it's very important. So let me just shed some light on the differences, some basic differences on term insurance and whole life insurance. Those are two basic types of insurance that exist. There are others, but those are main ones. Mm-hmm. So term life insurance is a very simple product. It's designed to provide an income tax-free payment to the people that you choose, known as your beneficiaries. Same thing like in estate planning, where your beneficiaries receive the benefit.
Yes, you have this target group, my main beneficiaries. That's who I worry about on a daily basis, right? That can be my kids, that can be my nieces, nephews, that can be my partner. That's your basic beneficiary pool. It can be one person, it can be more than one person, correct?
Correct, indeed. And could be a trust.
Yes.
Right. So these policies provide coverage for a set period of time, hence the name term. If you think of politicians, term limits, so same term, right? So I like to think of term insurance as we live in New York City, right? So we have a lot of office buildings. When you enter an office building, there is a security guard at the front desk. So imagine term life policy is like a security guard. And that policy can work for 10 years, maybe 15 years, maybe 20 years. And then after that set term, that person retires. And when that person retires, there is no more coverage. So that can happen while you're still alive, right? The term policy can just come to its term.
Yes.
So, but in the meantime, it provides sufficient coverage. It's very inexpensive, and you can purchase large amounts of coverage for relatively inexpensive dollars, right?
And the reason, I'm just going to jump in and ask you a question. The reason why it is so inexpensive and affordable, I want to say to the bulk of, the population and the majority of people, obviously they, pass all the necessary, verification by the life insurance company things and all of that. Why is it so inexpensive? Talk to us about that a little bit.
Well, cost of insurance is related to the risk that you present, the risk of dying, right? So the closer you are to your natural expected death or time of death, right? So that life expectancy, the riskier you are to insure, and obviously it costs more. If you're young, statistically speaking, you're not likely to die. I mean, things happen. People die of diseases, people die of accidents, but as a whole, a 90-year-old is way more likely to die than a 20-year-old, right? So that determines the risk, determines the cost.
Okay. All right. Thank you.
Right.
So I interrupted you. You were discussing the benefits and what the term policy offers you from day one.
Right. So when it comes to whole life or term life, if one dies, the beneficiaries will receive the amount that the insured person was insured for, and it makes absolutely no difference what policy the checks come from. In all the recorded history, it may be anecdotal, but I have not heard of any check being returned to the insurance company because it came from a wrong policy. Nobody has ever done it, right? So,
and by the way, those checks come in income tax free, correct?
Correct. So when the checks come in, they're always helpful to the family, the business is always welcome.
Yes,
right.
They offer this necessary source of immediate liquidity. Insurance comes into play in its basic form as a source of immediate liquidity. Nobody needs to wait to be appointed administrator of the estate or an executor of the estate for this probate to finish, for the contested proceeding to finish, the family's fighting, whatever. You had your beneficiaries or you had your trust, better yet, and that liquidity is available to your loved ones, to that pool of beneficiaries that you carefully selected and carefully chiseled out with your estate planner. Okay, that becomes available almost immediately with the term policy or the whole life policy, right?
Correct. Provided the policy is in force when you pass away. That's just a small caveat. So whole life policies, they're also insurance policies first and foremost. They're insurance policies, but they're structured a little differently. And the two primary benefits of a whole life policy is that, of course, you get a death benefit that's guaranteed when you pass away, but you also get something called cash value that can be withdrawn or borrowed against during your lifetime. So from day one, you get your death benefit, you get your cash value growth at a guaranteed rate that's insulated from market fluctuations. But also, while not guaranteed, mutual insurance companies may pay annual dividends to their policyholders based on the company performance. And that the dividend can increase the policy's value beyond the growth rate that was guaranteed, right? So cash value growth in your policy is also tax deferred. So you don't have to pay taxes on your cash value growth every year, like you would, for example, if you kept your money in a savings account. And that's during your lifetime, that provides a vehicle for savings and liquidity.
It's an investment. It's an investment. It's an approach to investment. That's what it is. But we're going to talk about this in depth in our other videos. But today, I also want you to just touch on one aspect. Tell me, if I have a whole life insurance policy and I have a significant amount of cash value accumulated in it because I was diligently making my premiums payments and the policy is up to date and everything's wonderful. And all of a sudden I am realizing that somebody's suing me because I'm a doctor and, somebody's alleging that I did something wrong. Is my policy under attack at this point as an asset? The cash value of my policy, is it under attack?
Cash value is not a separate account. Mm-hmm. Cash value is embedded. It's almost like a feature, an extra feature of a policy. It's not a separate account like a savings account. That's a standalone account. Mm-hmm. So even though you know about your cash value, it's not visible as a separate account. It just shows as a whole policy. Mm-hmm. And from your standpoint, you can access that cash value, but it's not available to creditors or predators.
That's what I wanted our audience to hear. And thank you very much. This is what we're going to continue this discussion. And we're going to touch on other aspects of owning policies, of buying policies. So stay tuned. Mr. Shafir, thank you very much for being with us today. And dear viewers, come back and see part 2 of this wonderful presentation. Take care.
Thank you.